So I want to talk about core trading strategy. So this strategy took me from a part-time trader in the military in the UK to a 3-year stint of being a money manager, making a load of money, and then running, okay? But what I did was I actually met Trade Ideas. Scott, I've known him for 6 years now, and their ethos of helping people, and it just rubbed off on me, okay? And they empowered me, if you like, to start a little hobby project to trade the fifth wave of the Elliott wave sequence, because I've been doing that for 15 years now. And I got a geek, and he made a bit of software, okay? And then a year ago, guy from Silicon Valley took the red eye, came to see me and said, Paul, this would make a great business. So this is where we are right now. Paul@tradethefifth.com is my email. I do answer even emails within 24 hours. There's a few of our users here, stalkers are here as well to spend the day with me. Bratby official is my Twitter. So let's get going. You're all big boys and big girls, okay? Okay, so I want to talk about trend behavior, and this is from the point of view of me, how I understand it and how I've understood it in the past and what I look for. So for the bulls, this is cut down a bit as well. I'm going to be quick. So when an institutional trader sees value in an instrument and buys a sizable amount of contracts or shares in that instrument, okay, other traders start to take note. And after similar analysis, using the same tools and the same techniques, even though they're across the road, okay, they start to buy. And that makes the price start to move up. Because no broker wants to sell it at that price now. Everybody's been buying it at that price. I'm going to put it up a little bit. And it moves. So that as momentum grows and more traders don't want to be left out, the price starts to trend higher. And we've seen those. So this doesn't last forever, because institutional traders are human beings. They do have quarterly bonuses. The wife wants a new Tiffany's ring, okay? There's lots and lots of reasons, and it's not necessarily to do with the institution they're trading for, it's personal, okay? So they will take half their position of Apple off, they'll take the money, and they've got a good bonus that quarter. There's lots of other reasons, that's just simplifying it. And also the people programming those algos. They're human beings after all. They're taking note of looking left and what's happened. So they're programming their algos for that. So yes, they have to take the bonuses, and if they bring a wife on a trip like me, she goes to Tiffany's, she goes to here, she goes to there, and I've got to go and work again now. Okay? For the bears. So when some of these early buyers start to take some of their positions off, they start to take profit. So I don't class it as a bear, I take it as taking profit, yes? So do some of the other institutional traders to cover some major sell-offs and to bank some of that profit. So they start to hedge a little bit now, start to take a bit off, a bit more off, and at a certain price point, these traders that sort of get into that herd move later on find themselves at a sort of slightly lower price than their original entry. So this is a critical time in trend behavior, because on that move up, some people just like to press buy, yes? And they're a little bit late, and that price starts to come down a little bit, and it's below their original entry price. So this is the critical time. This will work in a minute. So the pullback, okay? So if those traders in a slight loss-making position still see strong growth potential in that instrument, in that stock, okay, they'll buy more contracts or shares if they're trading futures at a lower price. So that lowers their average holding price. They're in a better position, okay? So those, I mean, a lot of you are day traders. I have a blend investment portfolio, so for me, I like those pullbacks. I can reduce the size of my average holding cost, and I own more Apple, and it's worth more money, okay? That's why it's such a critical point, because if people don't do that, there could be a lot of problems. So other traders see that bullish volume, and they see this herd pull back as an opportunity to get in that bull herd again, and then that starts moving it. I've got to be quick, I'm sorry. This usually takes about 45 minutes. So trend failure. So if those traders in a slight loss-making position start to panic, it's the end of the month, the quarterly bonus is coming on, and they just start that panic, and that's when that selling volume increases. They sell their positions to reduce the risk and loss. Yeah, they'll take 2 cents on the dollar loss and just wipe their feet, wait for all the big boys to start play again, and they'll come back in again. So they sell their positions, and some of those early entry traders see this high bearish volume to continue. So they decide to close the rest of their positions and take the remaining profit. So lots more traders then sell, and you get that trend failure. Okay, that's just a watermelon. Who's had that feeling in the markets just lately? Okay, it hurts. Okay, that was real. Whoa. Oh, just watch it one more time. Okay. Every time you want to enter a trade, think of that. Okay? Your jobs, and I tell all my guys, your jobs as a trader is to find a reason not to get in a trade. Okay? It's not, all these tools are brilliant, and we've got some great tools at Trade the Fifth. Trade Ideas, I've known them for 6 years, of tools are remarkable. But you need to find a reason not to get in a trade. If you can't find a reason, the likelihood is of getting hit like that is reduced. It's a bit counterintuitive, but that's the way I trade. Okay. So a trend on a chart. Who uses bars? Who uses candlesticks? Bars? Candlesticks. Wow, okay. Maybe from Europe we use bars. They're thinner. I lead to feel thin. So, trend on a chart. So a range period. So this is boring results on earnings. The CEO hasn't been caught with his pants down for a while. There's a lot of reasons why that range, the sector's just crap at the moment, okay? Look at the volume as well. So, I was in a room in Kansas recently with 40 OTA traders, okay? They're our users now. We've got, they've moved over. They've seen the light. So, they didn't even were taught about volume. Who thinks volume is half of the picture? Yes? Certain people don't even get taught volume. It tells a big, big story. So then we get that big impulse move out of that range, okay? You get a gap there. What do you think that gap was? Anybody? Earnings, okay? There was a little catalyst before, probably some rumor, a new widget came out, it started to move, then they had earnings, it was good, it kept going. Look at the volume. Look at that volume on the way up. Starts to increase. Now, there's a big formula for average daily volume. Throw that away, just put a line on the chart, that's good, okay? Then we have some profit taking. Look at the volume die as that profit taking is starting to happen. Remember, you should have the volume chart on your chart as well. We actually do something pretty cool. We color the candles different, don't we? So we actually color lower volume, either cyan or gray, to show that lower volume on the candle. You don't need that chart anymore. But you need to understand, when you get in a pullback, look how the volume dies off. Now we get a peak in volume and a rejection of a low, okay? That rejection of that low at that pivot point is extremely important. At that moment in time, it's a one candle wonder, okay? We don't make a decision right now, but if it starts to move away from there, that's a good pivot point in that behavior that I just talked about. And those traders that are in a slight loss-making position now, there's a big rejection. There was a lot of volume, buying volume that came in that low, and they saw some value and they started to buy. This is a daily chart, by the way. So the next day, we've got a higher high, higher low, slight drop in volume, always the case. But we then started to move away. Then you get that big impulse leg. Look at the volume. Building all the time. This is just behavior. Then we get another profit-taking pullback. Then we get another traditional candlestick pattern at the bottom of that pivot with higher volume. Anybody tell me what that is? Bullish engulfing? Yeah, the big green candle engulfing the little body of the red candle. Make it very simple. Then we get that last move up. See how that average daily volume on that last move up compared to that second impulse leg is slightly higher on an average, but it's less sexy, okay? It doesn't move as long as the first one, but it's pretty good. Slightly higher high, okay? Remember this, okay? So you get that slightly higher high. Now, I won't talk about volume and price action too much more. There's a lot to do that, but this is a cycle, okay? Between those, we've probably had one earnings. If you look on a weekly chart, you'll see a similar cycle, and you'll probably go three or four earnings. So what if we could measure this behavior in a consistent way? Or, right, I've got 2 degrees. That doesn't make me clever, okay? I read a book called High Probability Trading, okay? Don't read it. I'm clever, okay? But you need to read it 3 times just to understand the first chapter, okay? People like to look clever when they're talking about trading. I've taught my 7-year-old grandson to trade this strategy. At the age of 16, he will be getting a 10 grand account and he will be trading full time, okay? You've got to keep it simple and repeatable. If you can follow those same rules day in, day out, and I call it my sausage machine strategy, so the same ingredients, you're churning those ingredients all the time. You'll get a bad sausage occasionally, that's fine. But you just keep churning that sausage machine strategy with those same rules. Okay, so don't be afraid now, I'm going to mention something technical, okay? And when I mention this next word, you're all going to run out the door, because you've probably seen those guys that want to look really clever and talk about this particular subject. Elliott wave. Don't run, okay? So I want to use basic. I don't want to talk about inner waves and ABC corrections, ABC double corrections, and this, that, and the other. I want to talk about some basic rules and observations that you can follow to measure and track trend progress. Keep it simple, yeah? Very simple. 3 basic Elliott wave rules. 3 basic observations. And then you put it all together to form a simple, repeatable strategy to trade the 5th and final wave of that trend. Because all the other rules have been met. And the highest probability move is that 5th wave move. And some people say to me, how do you trade the 5th wave move? The 3rd wave. Get into the 5th wave. If that gets longer than the 3rd wave, it gets reprinted. And you get a really monster trade. Doesn't happen all the time. So why the 5th? It is the highest probability move. And we're not talking just about swing trading. I made my money swing trading, yeah? Swing trading off the daily time frame is the purest type of trading that you can have. The day opens, the day closes, it has a high and a low. You put all those together, you can see the trend or not. But you can use this on a 5-minute, and the users we've got there at the back, they day trade futures, okay? So even in a day, when indexes start trending again, you will see a trend. And if you can measure that trend and trade that 5th wave, and we recently did on oil, we did 45 ticks in 25 minutes, really good move, okay? So it works on all time frames because all the rules and observations have been met during the trend. When I first started this, I was in the military, I was trading part-time, I was very anal, very structured, okay? And I printed off sheets of paper with these rules that I'd filtered out over a bit of time, and I would tick a box for every single one. And if one of those boxes wasn't ticked, screw up the paper, throw it away. I wasn't going to trade it, okay? And that's the discipline that you need. So trend rules cannot be broken, yes? So we're going to talk about a similar sort of trend. I'm going to look at that first move up, that first impulse leg. That's a wave 1. So when you get that profit-taking pullback, that wave 2 pivot cannot exceed the origin of that wave 1. Otherwise, it's not a trend, is it? It's a roller coaster stochastic ride. It's going up and down. You need to see those, on an up channel, you need to see those higher lows. So The rule 2. Now, this is a bit subjective. The wave 3 cannot be the shortest of the 3 impulse moves, okay? Most likely, it is the biggest, okay? It's the sexiest. It has the most oomph, and it just keeps going. Then it pulls back. So it cannot be the shortest, but most likely it is the longest. So you can see here, we've got that 5th wave. In real terms, that is getting towards that 3rd wave. A few more ticks higher, that will all be reprinted, and that 5 will turn to a 3, okay? Because it then becomes longer than that original 3rd wave. So this is the critical one, the wave 4, okay? It must not pull back between the origin, the pivot of wave 1. So that means the trend has failed and you get a watermelon in your face, okay? So that wave 4 behavior is critical to trade the 5th wave. So the wave 1, the wave 2, that wave 3 rules, that's all good. And actually, in our software, we program that in. You don't need to think about it, okay? But the wave 4 behavior, it's really, really important. And we make our traders work a little bit. Okay, so the observations, yep. Now these, for me, are rules. People like to bend rules a little bit, and sometimes I may, if it's a really good wave 4 pullback, and one of the little observations is just out and it comes back in again. If I'm intimate with that stock, because I get intimate with stocks, okay, I will know that's in a good cycle and I'll trend it. But for our users, it's nothing, okay? So, observation 1. This is all about the wave 4, by the way. So when you're swing trading, or day trading as well, when that wave 4 pullback has 3 zones, and these are fib zones. Everybody like fibs? Yeah. Institutional traders use them. If you're in it, by the way, you're in a trade on a day trade, and it pulls back against you during the day, put the 382 and the 50 on. Just put that on there. It'll be freaky how many times it comes back to that zone and then go again, okay? I put that zone on when we were in a 5th wave move on oil on the 5-minute time frame. We had, 100 people in the 5K club that day, live trading, and it got to something like 30 ticks profit just before the wave 3, and it started to pull back. Everybody pressed sell. Only 5 people stayed in with me. And then it got to the 382 to the 50, and it held there for 15 minutes. Just kept going up and down, okay? Volume was dropping, everything was nice, and then boom, straight to the 5th wave in less than 3 minutes, okay? They made more money than the people. It's still good, they all made money, but that 382 to the 50, even if you're on a stock trade during the day, and it pulls back against you, put those fib zones on, okay? If it breaks the 50, 618, last chance saloon. If it breaks that, get out, because it's going to go. So the first zone is our green zone. So I put 2.5 because I'm keeping it simple, not the 2, 3, 8, 6, blah, 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 blah. Yeah, 2.5, 382. 85% probability it's going to go on and hit that 5th wave target zone. The 80% zone is the amber zone, and that's the most common, okay? 382 to the 50. And then the 618, 50 to 618 is 75%. Anything below that, you are rolling the dice. It's too deep a pullback, and we talked about behavior right at the beginning. Those people are starting to panic now, and they're going to sell, okay? So observation 2. Okay, who uses oscillators? Anybody? Okay, so an oscillator is actually just a histogram or a picture of the gap between 2 EMAs, okay? It makes it easier to view. It's off the chart, your chart isn't busy. And what we look for on the 535 oscillator, on that wave 4, it pulls back between 90 and 140% of the highest point on that wave 3 on the oscillator. Now, this is the one that I fudge a little bit sometimes. So if it just tips to 140, crowns and come back in again, and I'm really intimate with that stock, I know it's going to be a good 5th wave move, good probability elsewhere, I'll trade it. But in reality, if you're day trading stocks on this or day trading futures, that has to fall between there. It has to crown, it has to come back up again. Okay, then we have our false breakout stochastic. So this, We look at the 20 and the 80% overbought, oversold. Now, some people will say 25, 75. I'm conservative, I'm British, I'm just a little bit more room, okay? So it's got to be oversold is in the 20, overbought is in the 80. Those little yellow dots on there, that denotes really strong bullish trend. So on that wave 4, we pull back into one of our zones. We're between the 140 and the 90 on the 535, and the stochastic pulls back against that false breakout bar. It's like an elastic band. Where does it want to go? Back up to the top again, okay? Now, not every single one will print those false breakouts, but when that happens, that probability gets higher because you've got strong bullish momentum. Those false breakouts in the overbought zone denote a strong bullish move. And the other way around for bearish. Drink. So we're going to put all that together. Okay. So we've got a checklist, okay? Fifth wave moves, long or short, all must be ticked. Green light for entry, yeah? I better press this quite often then. So wave 2 must not retrace further than the origin of wave 1. Wave 3 cannot be the shortest. Wave 4 pull back into, not past that wave 1 extreme. And then we've got those observations, the pullback zones, 535, the stochastic. I'm going to be looking to get this done. Still not over, guys. There's one big rule that is the most important rule, and I need to talk about it. What do you think it is? Risk to reward. We need a simple and repeatable entry strategy with a minimum risk to reward. If we don't get the minimum risk to reward, we don't go in the trade. So we've done all that work, looks brilliant. Risk to reward is 1-to-1. Chuck it away. Don't want it. So we use what we call a 6-4 moving average high. So this is the average of the highs going 6 bars back, but we project it 4 bars forward into the future. So this is our conservative entry strategy. So the green one's the highs, the red one's the lows. Highs for long, short, red is for short. Okay? So here, pretty simple, candle closes on that day. The next day, the bar position is, we're above that 6-4 moving average high. That's our entry point. Now, we also have to consider to look left as well. So in this situation here, we have the 6-4 moving average low, but when we look left, we see really strong support on 3 candles there, 3 days. We need to be below that. Why would we go short into trouble? And I say to the guys now, you have to find a reason not to get into trade, okay? So you need to go below that support. You're not going to go into danger. So final ingredients, stop loss, slightly below the wave 4 pivot. The automated target zone on our software is printed. Simple. Minimum risk reward 1 to 1.6. That's my golden rule, 1 to 1.6. If we haven't got that, we don't get in the trade. Guess what? How many more 1,000 stocks is there? And the markets are open the next day as well. Don't try and get het up. Oh, it's 1.14. I'll just adjust the stop loss a little bit. I'll just adjust the entry. Simple entry strategy. Use the same rules every time. If it doesn't get it, don't go in. So this is using the NinjaTrader version of our Elliott Wave Indicator Suite. Wave 4's pull back, find support in the amber zone. Good looking trade. Got the false breakout stochastic on the top. This is Home Depot on the weekly. Yep. Part of my blend investment portfolio. Guess when I add in? On the 4th wave pullback. That's when I add to my blend investment portfolio. I trade those 5th waves on the weekly. I'll wait for another pullback and I'll do it again. We have false breakout. We've got the stochastic. Good. We've got the 535. Everything's looking good. We look for a simple entry strategy. Risk reward 1 to 1 to 2. Looks pretty good. Automated target zone. Stop loss just below the wave 4. Entry. Boom. Yep. Okay. So that looking a little closer at that, that's what it looks like. So fib extension, you are going to have to use a tool on your platform. Fib extension, 3 clicks on the fib extension, 1 click on the stop, next click on the entry, move it to the right and still click on the entry. That gives you your risk to reward. Target zone is automated. Don't fudge the entry to get the risk reward, okay? Put the entry on first, then measure risk reward. So I always risk 1% of my trading account balance on my swing trades, and the reward takes care of itself, okay? So why the 1 to 1.6? So if you've got a 50% win rate, okay, and your risk reward is 1 to 1.6, even if you're losing half your trades and your average win rate is 1.6, you're still going to be in profit, okay? If you're 1 to 1, you may as well go to the casino and play black or red and double down, okay? I've tried that, it doesn't work. Same with the shorts, same thing, 535, it's just a checklist. Follow those rules, don't deviate. Going back to these charges, you guys are lucky. Oh, I'm getting the red light here. Okay, so I get charged because I have to use a private broker in the euro because I'm English. But to access all the stocks I need, I pay $20 in, $20 out. Okay, you got to trade big to make those, and they're not changing. There's only 2 big brokers in Europe that can handle my trading on all the stocks I want to do, and those charges are astronomical. So shall I move to the USA is the question now. So exactly the same sort of thing, risk reward, minimum 1 to 1.6 into that target zone. This is an example here, aggressive entry strategy, regression trend channel. Anybody use those? Only use those for aggressive entry in a trending market, okay? Use a 6-4 moving average high if you don't. I'm going, yep. Risk reward, minimum 1 to 1.6, top end of the target zone, still good. So regression trend channel's automatic, okay? That's an aggressive entry. I went just above that little doji there, okay? That little warning sign. So the strategy is now complete. Very simple, but repeatable. And guess what? I got a geek to put it in a bit of software, okay? Now it's on TradeStation, Ninja Trader, Think or Swim. Write this down, San Diego 20. If you go to tradethefifth.com and you want to buy our indicator suite, you'll get 20% off, okay, for the next 48 hours. Or so the geeks told me. So again, boom, boom, boom. It gets boring, but trading should be boring. There's no emotion, yes. You get in, you have the same ingredients, you get out. No change. The excitement comes spending the money afterwards, or your wife spending the money afterwards. Okay, these take a while. So you see risk to reward in the big one, that is the most important thing. So Twitter, Bratby Official, my US business partners told me to share my life, so I share my life. Okay. So I live in Spain. I am British, but Brexit and all the other crap. You know, to be honest, politics in both sides of the pond, stay away from. So I'll be around for the rest of the day because I'm hanging out with the guys. So if you want to come and chat, just give me a shout. It's simple, and that's all it is. Thank you very much.